Hello, today we are solving October 2024 paper Unit 2. Question number 5. TopKrust PLC produces toasters. The company had a standard costing system and you are the cost accountant. A junior member of the accounting staff said to you, I will see that the figure for fixed overheads for September 2024 has fallen. I thought the word fixed meant the overhead figures does not change. Explain why an overhead may be categorized as fixed overheads. Fixed overheads are going to be the costs that do not change with the output. With the quantity of the toasters produced, it will not change. For example, a salary, a rent paid, okay, all this don't change, okay, with the number of output. So, but they will change over time. For example, after 2 years, you might have to increase the rent by a certain amount. You might have to increase the salary by some amount. So, these are fixed overhead costs. Two examples of the fixed overhead costs, okay, might fall. Okay, the two examples are rent and salary. How can they fall? Whether there is a negotiation, okay, negotiation for the rent, okay, so that you can ask for, depending on the demand and supply of property, you can also negotiate and salaries, or if some employees leave also, your salaries might be, or if the company is making a loss, then also salaries might get decreased. So two reasons when the rent might go down. So if there is less demand for the property, then rent goes down, okay, less demand, so the rent goes down, and there is a loss in the company and the salaries can be paid less, okay. These are the two things. The next one is part B. Complete the column to show the variances for the month of September 2024. They have given already budgeted costs and actual costs, okay. So what is a variance? Variance is the difference between the budgeted and the actual costs, okay, that's going to occur. So that is a difference, okay. Now let's calculate here the difference between the budgeted and the actual variance, and then name it as adverse or favorable, okay. There are two types of variances you are going to state for each, and then call these variances, okay, adverse or favorable. The costs in the revenue, you will, if the budgeted is greater than the actual, you will call it as adverse, and in the cost, if the budgeted is greater than the actual, you will call it as favorable. 500 minus 99 200, so that is equal to 25 300. So 25 300, this, okay, we will name it this one, okay, because the budgeted is greater than the actual revenue, so this is an adverse, okay, this is adverse. It has not been able to be within the budgeted revenue, okay. Then next one is cost. Let's look at the cost. The difference is 51 320 minus 50478, okay. So that is equal to 842. So the difference is 842. For the cost, the budget is greater than the actual, so you will call it as favorable, okay, favorable. Then let's calculate the difference between the labor cost. 12288 minus 11550, okay, 11550, that is 738. So 738, and then you can see that again the budget is greater than the actual, so it is favorable. 250 minus 17980, so that is equal to 730. So 730 30, and then you see that the budget has become less than the actual, so here it has become adverse. Then 80 858 minus 80008, okay, so that is equal to 850. So that is 850, and we can see the budget is greater than the actual, so it is favorable here. Then gross profit, let's calculate. So 43642 minus 19192. So that is equal to 24,450. 24,450. And here, just like revenue, if the budget is greater than the actual, it is called as adverse. Okay, let's calculate the difference. 27,750, okay, minus 26,340. So the difference is 1,410. Now this is also a type of cost, 1,410. Okay, so the budget is greater than the actual, it is a type of cost, so I'm going to call it as a favorable variance. Okay, it has a favorable variance. Now the net profit or the loss for the month, so 15,892 minus of minus 7,148, so it is equal to positive. Okay, it will become positive, so you will have to add these two, so that will become 23,040. Okay, when you are calculating the difference, and here it is okay, here the profit again is greater than the actual variance, so it is like a sort of revenue, so you will call it as adverse variance. Okay, this is an adverse variance. Now, next question. Calculate for the month of September 2024, showing the formulas used for labor efficiency variance. For this, some information is given here. The following information is also available for September 2024. Okay, here he is saying that the budgeted production, okay, the figure of 2,560 toasters was achieved. So they were able to produce this much quantity of toasters. Budgeted labor costs were 8 workers. Okay, there was 8 workers working for 40 hours a week for 4 weeks a month and at the rate of 9.6 pounds per hour. So the first question is labor efficiency variance. Okay, labor efficiency variance, this formula you have to know. Actual hours worked minus the standard or the budgeted hours that was estimated times the rate. The difference between these two times the rate will give me the labor efficiency variance has occurred. And when the variance you calculate and you see that if the actual hours has become less than the budgeted hours, I'm going to call it as a favorable variance, else it is an adverse variance. Actual hours should be less than the budgeted hours, so then it is called as a favorable variance. Now we here they have given the budgeted hours and the rate at which, this is the standard rate, this is the budgeted rate or the standard rate that was, okay, that was, this is the standard, this represents the standard rate. Okay, that is 9.6, and the budgeted hour. Okay, let's calculate the standard hours or the budgeted hours that is given. Standard hour for 4 months. Okay, so 8 workers, each working for 4 months, and they work for 40. So that is equal to 1280 hours. This is the standard hours. So the factory were not good. So one worker decided to leave on 31st August and was not replaced. This left 7 workers for the month of September. So instead of 8 in the month of September, only 7 were left. The trade union also called a meeting on 1st September and discussed the possibility of strike, walking out for a higher pay. So management offered a rise of 0.4. So for the business, 0.4 pounds an hour got increased. So the rate became not just 9.6, now the actual rate, okay, this represents the actual rate. So actual rate became how much? Actual rate became 9.6 plus 0.4, that is equal to 10 pounds per hour. So it became 10 pounds per hour. This became the actual rate. Okay, and also the budgeted hours got varied because one person left. Okay, this is a 7 workers only were there. So due to one member of the staff short, to complete the budgeted production, all the workers had to work for 5 more hours overtime on one Saturday at normal rate, improved pay rate. Okay, is the budgeted hours. Now the actual hours worked. Actual hours worked were, there were only 7 employees and they worked for 40 hours a week and they worked for 4. Okay, so that's the same thing I'm going to write here also. Okay, 40 hours a week, and also they work for some extra time. That extra time is going to be here. Here they have said that each worker had to work for 5 hours overtime on one Saturday. So those 7 hour workers had to work for 5 hours, extra hours worked. So that will be equal to, okay, 1155 hours. Okay, 1155 hours. So this was the actual hours that they worked. Now let's, what it is already given, standard rate. Now let's calculate the labor efficiency variance. Okay, so the labor efficiency variance is going to be equal to 1155 hours minus, okay, minus the budgeted hours or the standard hours, okay, that was set earlier for the standard rate, okay, and times the actual rate that was paid to the laborers, that was 9.6, okay, 9.60 rate was paid. So this is, you will include, okay, so that is equal to, okay, that is equal to 1200 pounds. So you will include 1200 pounds. The hours has got, actual hours has become less. Okay, the actual hours has become less than the budgeted hours. It is a favorable variance. Okay. Then next one is the labor rate variance. Labor rate variance is, the formula is actual rate minus the standard rate times the actual hours worked. And if the actual rate is becoming greater than the standard rate, we are going to call it as adverse variance. Into the actual rate. Actual rate is equal to this one. Okay. 9.6 plus 0.4 extra they did a strike and got, so it had become 10 pounds. First is going to be this much. Now let's calculate the labor rate variance. The labor rate variance is going to be equal to the actual rate. Actual rate is 10 pounds minus the standard rate, the budgeted rate that was estimated, times, okay, times 1155 hours, actual hours work. So that is equal to, okay, that is equal to 462 pounds. Okay, so that value is going to be 462 pounds.